cryptocurrency prices have fallen dramatically in recent weeks and months, and it appears that the bottom is even lower than everyone had anticipated. Recent news of the US-based cryptocurrency exchange Binance withdrawal from a planned acquisition of a rival exchange, FTX Trading, 24 hours after making the announcement sent shockwaves through the investment community as worried investors withdrew their crypto funds, leading to the company's demise. Here we will talk about war trading because of crypto crash. Before we move further, press that subscribe button. Let's start. The local FTX firms in Australia, FTX Express Proprietary Ltd and FTX Australia Proprietary Ltd, have also engaged insolvency and restructuring firm, Cordamenta, to act as administrators. Since then, FTX has filed for Chapter 11 bankruptcy in the US. Cordamenta will examine the Australian FTX firm's financial records to see whether any money can be saved for regional cryptocurrency investors. According to documents submitted to the Supreme Court of Victoria, the demise of FTX has cost nearly 30,000 Australian investors money, some of them by as much as $1 million. Sam Bankman-Fried, the once revered millionaire founder of FTX, apologized repeatedly on Twitter before reportedly escaping to the Bahamas, where the business is domiciled. Naturally, the swings wreaked havoc on the markets for cryptocurrencies. The price of Bitcoin dropped from above $20,000 earlier in the week to $15,978 over the course of 7 days, a 23% decline. Ethereum, the second biggest cryptocurrency, fell 24% in just 7 days. In fact, the more closely a coin was related to Bankman-Fried, the more it plummeted. For example, the billionaire's favorite, Solana, SOL, dropped 60% in a week, while FTT, the native coin of FTX, dropped more than 90%. This is hardly BTC's first stumble of the year. The recent decline of Bitcoin started back in May when it dropped below the psychological threshold of $20,000 as a result of a larger crypto market crash. Previously, Bitcoin traded for roughly $69,000 per coin. Bitcoin lost 30% of its value in a single week in June, but as of late October, it was still trading at about the $20,000 level. As of right now, it is battling to achieve the $16,000 barrier. When cryptocurrencies experience such steep declines across the board, many investors and enthusiasts start promoting the ancient investment maxim that it's time to buy the dip in the hopes that these lows herald a brief downturn rather than a protracted bear market. But is that prudent? There is no denying how significant the crypto decline has been. The market capitalization of all crypto assets has decreased since last November from a combined $3 trillion to about $900 billion. In response, certain US cryptocurrency lenders, including Celsius Network, Babel, and Vault, froze withdrawals. Meanwhile, other exchanges, like Coinbase, laid off personnel. While Cardano, ADA, suffered even larger losses, plummeting to 46 cents. ETH experienced losses comparable to those experienced by Bitcoin in previous months, plunging to almost $1,100. All of this occurred before the FTX collapse. Although this fall hasn't yet reached the same severity as that of 2018, when Bitcoin lost 80% of its value, analysts warn that things could still get worse for those who are still holding BTC, long seen as the leading indicator of cryptocurrency. Before we move any further, subscribe our channel. These kinds of losses are what have spurred consumer advocacy group Choice and Australia's corporate watchdog, the Australian Securities and Investments Commission, ASIC, to remind individuals of how unpredictable and risky cryptocurrencies are. Investors would likely lose all of their money when a cryptocurrency fails, according to a statement made by ASIC on its MoneySmart website. The majority of nations do not recognize cryptocurrencies as legal money. The website also issues a warning regarding the prevalence of cryptocurrency frauds, and Choice is advocating for more consumer protections. It's important to remember that following its demise, FTX Trading purportedly experienced a hack, with unauthorized transactions showing that $600 million had vanished from the exchange's wallets. The Australian government is presently token mapping the crypto environment to get a feel of the business and plans to introduce regulations next year to help protect consumers against crypto shocks and scams. Inflation, recession, and war. According to Oleg Geiberstein, a co-founder of the automated cryptocurrency trading platform CoinRule, the market is experiencing the same pressures as the rest of the economy, which is why prices have fallen. Everything is down, not just cryptocurrency, and the economic picture is bleak for the next 6 to 12 months, he declared. In light of the poor economic growth and high inflation, central banks are in a difficult situation. Investors are fleeing risk on assets like cryptocurrency and tech stocks as a result. Geiberstein thinks the market might stay difficult for up to 2 years, but warned that things could get worse during that period. This downturn could either be the start of a long-term trend or a brief hiccup. The miseries of Bitcoin and other coins weren't happening in a vacuum, according to Sam Kopelman of the cryptocurrency exchange Luno. Earlier this year, investors sold a wide range of assets as global equities experienced their worst day since June 2020. The market is struggling with the effects of the US interest rate crisis and the war in Europe. Chris Berg, co-director of Remit's Blockchain Innovation Hub, and Australian experts concur that inflation was to blame for the FTX sharp drops. Investors start selling off risky assets as central banks, like those in Australia, raise interest rates to fight inflation. According to Dr. Berg, crypto is the ultimate risk asset, so it's the first to fall. Is buy the dip a smart move? The tenet of buy the dip is founded on the idea that price declines are transient aberrations that eventually right themselves. By purchasing at a relative discount and profiting when prices increase once again, dip buyers attempt to take advantage of dips. Buying cryptocurrencies at any price, let alone one that may turn out to be a long-term trend, is risky due to the volatility of the cryptocurrency markets. Prices might go back to where they were, but they also might drop significantly more, leaving your investment in the red. If history is any indication, this dip or crash, depending on your point of view, may recover like it did the year before, when prices dropped to a similar level before rising to their pre-dip levels and even peaking in the fall. Naturally, though, they might not. In instance, Bitcoin values have up to now demonstrated some seasonality, appearing to decline in value to varying degrees in the autumn before rising again in the early winter. Past performance, however, is not a guarantee of future outcomes, as is true of all investments, let alone those made in the uncertain realm of cryptocurrencies. After hearing of the FTX crash, the price of Bitcoin dropped below $16,000 after months of circling around $20,000. Many a rookie investor has been burned trying to grab falling knives, according to CoinRule co-founder Oleg Geiberstein. He recommends individuals who are committed to buying the dip to set aside a specific sum of money each month that they feel comfortable utilizing to purchase BTC or ETH and to not worry too much about what will happen to prices over the following 2 years. By hedging their bets, buyers are advised by Yrex's Pavel Matveev. To reduce risks, he advised diversifying your cryptocurrency holdings with a variety of altcoins. So what do you think about the ongoing situation of crypto? Share with us in the comments and hit that subscribe button for more amazing videos.